What if the greatest economic crisis of our lifetime didn't happen to central banks, but happened because of them? What if the collapse, the inflation, the rising debt, the distorted markets, and the impossible choices people face today were not unintended side effects, but predictable outcomes of a system designed to concentrate control, funnel wealth upward, and maintain a quiet dependency on the very institutions claiming to stabilize the economy? What if the crisis wasn't a failure, but a strategy? Today we explore a story most people never hear: how central banks engineered a crisis they secretly benefit from. To understand the truth, we must go back to the moment when the world gave extraordinary power to institutions with almost no democratic oversight, institutions that now determine the fate of global markets with a single policy decision. Section 1. The Origins. When central banks stopped being referees. Our story begins in the early 20th century, when the world was struggling to rebuild after catastrophic wars and economic collapses. Nations needed stability, predictability, and a central authority to guide the financial system. Central banks were supposed to be neutral guardians of value. Their job: control inflation, manage currency, and respond to emergencies. But something changed. In 1913, the U.S. Federal Reserve was created after decades of lobbying by powerful banking interests who wanted a centralized institution to manage liquidity. For the private banking sector, what began as a solution quickly became an opportunity. Because central banks had one unique ability: they could create money out of nothing. This power came with a dangerous side effect. If money creation could solve financial issues, then crises big or small became opportunities to expand influence. The more instability occurred, the more central banks were required to intervene. And with every intervention, their authority grew. Section 2. The Rise. Managing markets, managing governments. The Great Depression of the 1930s and the economic chaos following World War II accelerated central bank expansion. Countries turned to centralized monetary systems, believing they were too big to fail safeguards. But by giving central banks the responsibility to maintain economic stability, governments also gave them a political role. Monetary policy became a tool not just of finance, but of governance. The shift intensified in 1971 when President Richard Nixon severed the U.S. dollar from gold. This freed central banks from the final constraint on money creation. Now, money didn't represent gold. Money represented debt. Debt could expand infinitely as long as central banks controlled interest rates. This is when central banks began influencing inflation, employment, housing markets, stock prices, global trade, government borrowing, and soon. Markets weren't responding to supply and demand. They were responding to central bank policy signals. By the 1990s and early 2000s, central bankers became economic celebrities revered for their ability to save markets with rate cuts and liquidity injections. But prices and inflated asset prices made investors dependent on central banks, a dependency that would eventually culminate in disaster. Section 3. The Breaking Point. A system built to fail. The 2008 financial crisis was an accident. It was the direct result of decades of artificially low interest rates, expanding credit, and growing leverage. When the housing bubble exploded, the entire global financial system nearly collapsed. Who stepped in to save the day? Central banks. They flooded markets with liquidity. They bailed out giant banks. They slashed rates to zero. They began buying bonds, mortgage securities, and eventually corporate assets. The result is the largest transfer of wealth to financial institutions in modern history. But here's the twist. By intervening this aggressively, central banks didn't just prevent a collapse. They rewired the system into something far riskier. Markets became addicted to stimulus. Governments became addicted to cheap borrowing. Investors became addicted to guaranteed asset pumping. Corporations became addicted to debt-financed expansion. Households became trapped in rising costs and stagnant wages. Central banks became the central planners of global finance. Section 4. The Falling Dominoes. How the crisis deepened. Enter the 2020 pandemic. Economies froze. Production halted. Unemployment skyrocketed. And once again, Central banks saved the system by printing trillions. But this time, the scale was unprecedented. The world experienced the largest monetary expansion in human history, zero interest rates everywhere, direct intervention in stock and bond markets, massive government borrowing funded by central bank purchases. It was a perfect recipe for inflation, and central banks knew it. Why? Because inflation, while devastating for households, is beneficial for governments. It erodes the real value of government debt. It boosts tax revenue. It forces savers into risky markets. It concentrates wealth in asset owners. It increases reliance on central banks for stability. By 2021 to 2023. Inflation exploded across the world. Central banks responded by blaming supply chains, geopolitics, or fiscal policy, anything but themselves. Then they raised interest rates at the fastest pace in 40 years. This created the next crisis. Mortgage markets froze, bank balance sheets collapsed, sovereign debt hit unsustainable levels. Corporate borrowing costs skyrocketed. Consumer debt exploded once again. Central banks claimed they were fighting the crisis. But the truth is simpler. They created the instability and now controlled the remedies. Every crisis deepens the world's dependency on them, and dependency is power. Section 5. Failed fixes. Why solutions never work. Governments propose stimulus spending cuts, inflation targets, rate hikes, debt ceilings, banking regulations, austerity packages, but none of these fixes address the cause. Because the cause isn't policy mistakes. The cause is the system itself. A system where money is created as debt growth requires borrowing markets react to central bank signals. Not fundamentals. Governments rely on central banks to fund deficits. Central banks rely on crises to expand influence. The solutions don't fail by accident. They fail because success would remove the need for the institutions that created the system. And so the cycle continues. Crisis gives intervention, gives dependency, gives power, gives new crisis. Section 6. Modern parallels. The pattern exposed. Look around the world today. The U.S. debt just passed $35 trillion. Global debt has exceeded $315 trillion. Over 70% of all new money created since 2008 came from central banks. Nearly every major asset class is artificially inflated. Wealth inequality is at levels not seen since the Gilded Age. Household debt is rising faster than wages in 80-plus countries, and yet every time markets panic, every time governments overspend, every time inflation spikes, the world looks to where? This isn't coincidence. It's structure. And the structure ensures that the institutions responsible for the crisis are also the institutions that profit from managing it. 3 takeaways. 1. Central banks are no longer referees. They are participants. Their actions shape markets, influence governments, and determine the direction of the global economy. 2. Crises expand central bank power. Every collapse increases their authority, their tools, and their influence over policy. 3. The system isn't broken, it's self-reinforcing. The instability we experience is not a malfunction, it's a feature. Final warning: a financial system that depends on constant central bank intervention is a system that cannot sustain itself without ever increasing control. And when institutions with unlimited money face no real accountability, the crisis becomes permanent. The question isn't whether central banks engineered the instability. The question is, how long until the next crisis gives them even more power? Call to action if you want to understand how this crisis was built, who truly benefits from it, and what comes next. Make sure to like, subscribe, and tap the notification bell so you never miss the next chapter, because the story isn't ending, it's accelerating.